It is a very serious crisis. There's one piece of good news, which is that compared with our previous economic outlook, we have revised down slightly our projections for public deficits and debt, but they are still enormous. It's still the case that by next year we will have public debt across the OECD area of around 100% of GDP and still rising, and rising rapidly. And that means that countries will have to do quite a lot just to stabilize the debt to GDP ratio at a level which is going to be very uncomfortable. Some governments have already acted, forced in some cases by market pressures, in others just by the sheer severity of the situation. One can think of countries in Southern Europe which have been much in the news recently. But we say that in general, across the OECD area, countries that have not yet started to move will also have to move from 2011. And we're in a situation where all countries have to tighten at the same time. So they will feel not only the effects of their own tightening, but also the effects of the tightening that their neighbors are undertaking. So for that reason, it would be nice to proceed in an orderly manner. But to be able to do that, there's one precondition, which is to be credible. And in order to be credible, governments have to get out there with some clear strategies and plans for how they're going to consolidate. And there, in many cases, we still lack those plans. This problem is so big that it's really hard to imagine that one can solve it only on the spending side. There will have to be tax increases as well. And there we are saying that it does matter what taxes you raise, because some taxes are better or worse for long-term growth than others. For example, if you tax fixed property, it's not nearly as harmful for long-term growth as if you put income taxes up on either corporations or individuals.